Welcome to the Wealth Wisdom, where money has history and knowledge becomes power.
How can the entire world owe more money than actually exists, and the system still keeps working? Think about that for a moment. You constantly hear reassuring phrases like, countries are paying down their debt, governments are reducing deficits, economies are stabilizing. But when you look at the actual numbers, something strange happens. The global debt total doesn't go down. It goes up. Again and again, relentlessly, predictably, almost mathematically destined to rise forever. So here's the mystery. If every nation says it's trying to reduce debt, why does global debt hit new record highs every few years? And here's the part no one talks about. Why has no modern country ever reached zero debt? Not one. It forces us to ask a disturbing question. Is the global debt system designed to never be repaid? As we go deeper, you're going to see a pattern, a self-feeding loop. A system that doesn't just allow debt, it requires it. And once you understand how this system was built, who benefits from it, and why escaping it is almost impossible, the world economy starts to look very different. This is the story of how the global debt spiral began, how it accelerated, why it tightened its grip, and what it means for every person alive today. Let's begin. Background: the world before the spiral. To understand today's endless debt cycle, you have to imagine a world before infinite credit, a world with natural limits, a world where money was physical debt, had boundaries governments couldn't overspend, and economic growth was tied to something real: gold. In the early 20th century, there was a strict rule. A country could only print money if it had enough gold to back it. Gold didn't care about elections, promises, or wishful thinking. Want a bigger military? Get more gold. Want to create new social programs? Get more gold. Want to print more money? Again, get more gold. This frustrated governments because it limited their ambitions. Then came the World Wars, a moment when countries needed money fast. Gold limits suddenly became inconvenient. So governments did something they promised was temporary. They printed more money. They borrowed more. They stretched the rules. And like many temporary government decisions, they never went back. After the war, leaders started asking a dangerous question. What if the economy could grow without limits? That question became the seed of the modern debt system. And although Roosevelt played a major part in reshaping the dollar and the world's financial structure, nobody at that time could imagine how massive the debt spiral would eventually become. Origins: when debt became the engine, the modern debt system wasn't an accident. It was a series of deliberate decisions, some public, some behind closed doors, that turned debt from a temporary tool into the fuel of the entire economy. Here's how it happened. Bretton Woods, the new financial world order in 1944, as the world was rebuilding after World War II. Global leaders met at Bretton Woods to design a new economic system. Their agreement was simple. The US dollar would be tied to gold. Every other currency would tie itself to the dollar. And the US promised to exchange dollars for gold on request. It created something unique. A system with the appearance of gold stability, but with loopholes and flexibility. And underneath the surface, trouble was brewing. The US began printing more dollars than it had gold. The world noticed. Suddenly, there were more dollars in circulation than gold to support them. The day the gold window closed by the late 1960s, countries like France demanded gold instead of dollars. The math didn't add up anymore. Too many dollars, not enough gold. So, on August 15, 1971, President Richard Nixon made a historic announcement. The US would no longer exchange dollars for gold. The gold standard was dead. Money floated freely. Limits disappeared. And debt was unleashed. This wasn't just a policy change. It was the birth of a new era. The era of unlimited debt. Fractional reserve banking. The magic trick with gold gone. The banking system took center stage. Fractional reserve banking allows banks to create money out of thin air every time they issue a loan. If the bank lends you $100,000, that money didn't exist before. It was created through debt. In this system, debt is money. That's the engine. That's the mechanism. That's why debt can't go to zero. Because if all debt disappeared tomorrow, the entire money supply would collapse. No government would risk that rise when debt became the default as soon as the gold standard died. The world economy entered an era fueled by debt. It didn't just increase, it exploded. Governments borrowed more. Need to fund social programs? Borrow. Expand the military? Borrow. Build infrastructure? Borrow. Win elections? Borrow. Raising taxes was unpopular. Cutting spending was riskier. Borrowing was the invisible option. Corporations borrowed more. Cheap credit encouraged expansion. Takeovers, stock buybacks, higher leverage, bigger risks. Debt became a business model. Consumers borrowed more. Homes, cars, education, vacations, gadgets, a lifestyle built on credit. Wages didn't keep up, but borrowing did. A system dependent on rising debt. Here's the twist. The modern economy collapses if debt stops growing. Why? Because every loan requires interest, and the money to pay that interest must come from new loans. It's a loop. Debt gives interest, gives more debt, gives more interest, gives even more debt. This isn't a flaw. It's the design. Breaking point. Crises that exposed the system. Fragile systems crack under pressure. Before the big collapse of 2008, the world saw smaller warnings. Latin America in the 1980s, Japan in the 1990s, Asia in 1997. Different countries, same story. Overborrowing gives bubbles, gives collapse, gives bailouts, gives even more debt. Then came the big one. 2008. When the mask fell off, the financial system built massive amounts of invisible debt. Subprime mortgages, derivatives, leverage on top of leverage. When it fell apart, everything froze. For a moment, the world saw reality. Banks didn't have the money they claimed. Governments didn't have the money they promised. The economy didn't have the money it thought existed. Two choices appeared. Let the system collapse or print unimaginable amounts of new money. The world chose printing. Trillions in bailouts, zero interest rates, governments borrowing like never before. This didn't repair the system. It locked us into this spiral permanently. 2020, the acceleration moment, the pandemic. Hit the fast forward button. Governments printed more money in 2 years than in the previous 20. Stimulus checks, corporate rescues, unlimited interventions. Debt became oxygen. Cut off the oxygen and the economy would collapse instantly. Even economists admitted there's no going back, only managing the expansion. The spiral was now permanent. Fallout. The cost of a debt-driven world. Endless debt comes with consequences. Built-in inflation. When money supply rises faster than productivity, prices must rise. Not a glitch, a built-in feature. Exploding wealth inequality. Those with asset stocks, property, businesses benefit from inflation. Those living on wages fall behind. Debtors win. Savers lose. Governments become addicted to stimulus. If borrowing slows, markets crash, unemployment rises, GDP drops, politicians lose power. So the borrowing continues. Currency value slowly erodes, not suddenly, silently, gradually. Crises become more frequent. Each rescue requires more money than the last. Failed escape attempts. Every proposed solution crashes into the same wall. Reducing debt collapses the system. Raising taxes kills growth. Cutting spending triggers recession. Raising interest rates increases borrowing costs. Lowering rates encourages more borrowing. Banking reforms politically impossible currency resets. Temporary digital currencies. Efficiency, not a fix. Returning to gold destroys modern economies. Every path leads back to more debt. Modern parallels. Data that reveals the truth today. Global debt is over $300 trillion. That's 3 global GDP. 20. The amount of physical money. More than humanity could repay in centuries. Look at the growth. 1970. $10 trillion 1990. $40 trillion 2000. $80. T 2008. $140 trillion 2020. $260 T 2024. $300 trillion plus. That's not growth. That's a runaway curve. History shows the pattern. Every empire that relied on debt eventually collapsed. Rome, Ottomans, British Empire, Soviet Union. The formula is always the same. Debt gives expansion, gives overshoot, gives collapse. And today, for the first time, every nation is in the same cycle at the same time. No one can save anyone else. Everyone is sinking together. 3 key takeaways. 1. Debt is the foundation of the modern economy. Growth depends on constant borrowing. 2. The spiral cannot be reversed. Stop debt gives collapse. Grow debt gives inflation. There is no neutral option. 3. The system is not designed to reach zero debt. Zero debt would mean no money, no banks, no budgets, no trade, no economy. Debt must grow. That's the structure. Final warning: spirals don't unwind. They break. This system won't end with careful planning. It will end the way all unstable systems end. When the next shock hits, one big enough that more debt can't fix it. Inflation, currency crisis, conflict, technology, or something no one expects. Nobody knows the trigger, but the curve is getting steeper, and history is clear. When debt becomes the economy, the end is never gentle. The real question is, will the next reset be controlled or chaotic? If this deep dive opened your eyes, and you want more content that exposes the hidden systems shaping the world you live in, subscribe, like the video, share it with someone who still believes global debt is temporary. Understanding the spiral won't stop it. but it will help you prepare for what comes next.